Hi, this is the Business Guy. I have a very special episode for you today. It's going to be my son and I talking back and forth. Going to be some father and son exchange. I'm in Florida. Adam is in Nashville. How you doing, Adam?
I'm doing great over here in Nashville, just in my buddy's house in their guest room. So I'm kind of working with what I got for the video, but
very good. So go ahead. I'll let you take it away. You can interview me. Let's do it that way.
Okay, yeah, sounds good. So I think one thing I really wanted to talk about, because we've talked about this a few times, is one of my favorite real estate and business type books is Rich Dad Poor Dad.
Right.
I really like a lot of the advice that it offers. However, a lot of the book does talk about debt, and essentially one of the core ideas of the book is that taking out debt is almost like a tax-free income type of thing, as long as you're using it correctly, as long as you're using it to generate cash flow. And I know when I was younger, you used to say that, if you have debt on something like a house or something that's low interest debt, as long as you're getting something out of it and it's not depreciating in value, say, for example, student loans or a house, or name your type of debt that would possibly benefit you. As long as it's below the average return of the S&P 500, then it's okay. But later in life, you should seem to shift that mindset into that, taking on no debt is the best option. Having as low debt as possible. It doesn't matter the interest rate. All debt is bad debt. So I just wanted to get your thoughts on that and why you might have changed your mindset on that.
Well, I think we have to not call any kind of debt good. Think about it. Debt will go is negative on your balance sheet. It's a decrease in your net worth. And so when you think about debt, if everything works out well, then we might say good. But let's not follow the advice of the 19-year-old on TikTok. Let's follow the advice of somebody who's become a multimillionaire, right? And so when they do a survey of millionaires, they find that one thing they share in common is they avoid debt. Okay, now let's go ahead and explain that. Let's say you have somebody bought 15 rental homes, and that sounds kind of nice. You'd have income of 15 rental homes. And so if you do your income calculation, that's if the houses stay full to a certain percentage, right? And everybody pays the rent on time, then it's great, right? Then somebody might say, well, that's good debt, because if you have this number of houses and you have this amount of income, wow, whoop-de-doo, I can make this much money. But that doesn't account for the risk. And the risk is your tenant not paying. Now, I've owned rental properties, right? I do rental property right now. And if somebody doesn't pay and you still have that debt, well, how good is that debt? You have 15 properties and then there's a global pandemic moratorium and you still have the mortgage, but none of those people are paying you. Well, how good is that debt? So let's not call it good debt or bad debt. Let's call it, sometimes it can be a tool, but we want to minimize the amount of risk. So we've got to take into account not just if everything works well in the ideal world, we have to take into account the risk that could come into the equation unexpectedly.
I see.
But the silly thing that people think they can do is, they borrow money over here to invest it over here because I'm getting a better return. That's not taking in the account of risk. And then you have the foolish people who do this leverage thing. I've seen so many people go really broke really quickly using leverage, like especially in the stock market or real estate, and it just comes crumbling down like a house of cards. So the people that don't consider the risk are not the ones that win financially.
I see.
And by the way, guess who owns the trademark Poor Dad? Right? I actually own that trademark.
Do you really?
Now, I'm not the Poor Dad, but I own the trademark Poor Dad. People think Robert Kiyosaki owns it. No, I own it. Right?
Have you had any trademark issues with that? Where they're trying to get that?
Well, it's not really possible because
for themselves or Robert Kiyosaki.
It's already gone past that point. So they can challenge it within a certain number of years. That's long gone.
I see. See, does he own Rich Dad, I wonder?
He does own the Rich Dad trademark, and he tried to trademark the Poor Dad trademark, but I already had it. So he can get it. I got it. And I've had it for a lot of years.
Okay. That's amazing. What are you going to do with that website?
We shall see.
Okay. Sounds good. Yeah. So I guess going back to the debt scenario. So say someone were really wanting to start a business or get a rental, generate some passive income. They're trying to become financially independent and they don't have any money. What do you think a good thing besides getting into debt would be? Like, what other options do you think they have? Someone might want to buy a rental property. Do you think they should, work for a long time until they have all the money to pay the house off? Or if they want a rental, do you think they should, put 20% down? What are your thoughts on that?
Well, the thing is, I don't want to reinvent the wheel when there's already a great wheel. And I really do subscribe to the Dave Ramsey program because I've read 2,500 business books and I've never seen any better financial education than what that organization teaches. I really, really do like it and I really believe in it. So the first thing is to have a starter emergency fund. Put $1,000 aside. That way when the flat tire doesn't become the emergency, right? You have the money to cover it and you have some room to breathe. And next start paying off debt if there's any debt. Starting with the smallest and up to the largest, regardless of interest rate. Because once you get the smallest debt paid off, it's a psychological boost, an adrenaline rush. And you take that payment and then you roll it into the next highest payment. So make the minimum payments on everything else, right? And then once you get that paid off, the smallest debt paid off, roll whatever you're paying monthly into the next biggest debt, and you kind of snowball the debt payoff. Right from the Ramsey program. There's no sense on reinventing it. It works. Next is to have so you have your starter emergency fund of $1,000, pay off your debt, and then you have a 3 to 6 months emergency fund so that nobody can ever put their thumb on you again. You have that much, 3 to 6 months of your expenses set aside, right? So that nobody can put their thumb on you. Job loss, so you're good. Then you get into the investing.
Okay, so
we
if a person is in
proper order.
Right. So if a person is in a lot of debt, they have credit cards, they have maybe home debt, they have student loans. Which ones do they pay off first? Do they pay off the ones with the highest interest rate first?
No, you pay off the smallest one first. Logically pay off the highest interest rate first. That's the logical thing that you think, oh, that's what you should do. But no, you pay off the smallest amount of debt first because it's a psychological adrenaline. Once you get that done, it's more effective. They've tried it both ways. And, it's like, different diets you can try. It's not what theoretically works. It's what actually works in the real world. And when they've done studies both ways, paying off the smallest and works better than paying off the highest interest rate debt. And you simply roll what you're paying.
We're not robots.
Yeah, we're not robots.
The logical thing might not be the best option. You got to take the emotions into account. So yeah, I totally agree with that.
Yeah. So by following these principles, I set myself up so I never have to work another day for the rest of my life. I live in a $3.5 million home, have a business. I don't have to work anymore. I work because I love it, and I love helping people, and I love having employees and seeing them prosper, do better, and help them mentally, and see their families do well. That turns my crank because I don't need to work anymore if I don't want to.
Do you have any debt yourself?
I do have a mortgage on the house. That's all. No other debt besides that.
Okay.
Small mortgage on the house.
How long is it going to take you to pay that off?
I could pay it off right now. 2.5% interest. Okay.
What's your goal? How long do you want to take to pay it off?
It really depends on on the other options and what's happening in the market. So I don't really have I go by what is happening in the current financial environment rather than because I could pay it off right now. It's no problem at all.
Right. So yeah, I guess that kind of gets back to what I was saying earlier with the high interest, low interest debt. So clearly, even though your thoughts are that you should be in as little debt as possible, clearly there is a point where it's a low enough interest rate where you wouldn't want to pay it off like your home since it's 2.5%. You're not going to want to pay it off immediately because you can clearly get a lot more return from stock market S&P 500. I guess what type of debt is that okay with? Is there a certain interest rate where you would say it would be not a good idea to pay it off immediately? Like how? Okay,
here's
how
the question.
Low would you consider?
Here's the question: would you get a loan on your car to invest that money?
No.
Oh, yeah, I wouldn't either. It'd be foolish. It's better to have no payment because that doesn't take into account risk. Because investments, these 19-year-old TikTokers, they talk about the financial scenario as if everything goes perfect, this is what you can do. We're driving around these fancy cars that they rented, or maybe they own sometimes. And but the key thing is, this isn't about rah-rah getting views on TikTok. This is about real life. And real life there's risks. Investments go down in value.
Right.
They don't just go up, they go down in value. We had during the 2008 real estate crisis, we had, I think it was, 37% drop in real estate? 37% drop. Wow. Right? It went up after that. During that time, a lot of people panicked and sold at the wrong time. Stock market crashed, right? So what if somebody borrowed a whole bunch of money on their house or their car or whatever, they put it in investment, and that happened? Right? So somebody borrows $500,000 on a house they own, and they put it in the stock market, and the stock market tanks in half, or whatever investment they have in half, or to zero even. They still have a huge debt to pay off. So that's why you don't use debt to invest. It's not a good strategy. Now, with a real estate investor, as long as it's a big down payment, maybe that might make sense. I'm not a big fan of investing with debt, even in real estate. The only debt I'm okay with is buying a home that you live in. But using
so your primary residence is what you're saying.
Primary residence, yeah. Now, using debt to invest in real estate, okay, maybe. I think a big down payment or paying cash is even better, because then if the crash happens and if their tenant stops paying rent, sleep like a baby. I'm all about peace of mind. And somebody say, well, yeah, that's because you're a baby boomer, you're the age you are, and you have money, blah, blah, blah. Yeah, well, that's the way I got here, by following those principles. I got here by following those principles.
I see.
I'm not saying from the position I am, that's what you should do. I'm saying that's how I got here. By following those principles.
For someone that, say someone had a very high-paying job, they got out of college, they ended up landing some job that's maybe paying them 6 figures, and over the years, over a few decades, they might have amassed a good amount of savings, but they didn't really have much financial knowledge. They didn't really put it in any stocks. They just have it kind of sitting on the sidelines. What would you say would be a better option for them, for someone that might have a lot of savings, but it's just sitting there, getting devalued by inflation? Would you say it would be better for them to put that in the stock market or an ETF?
If you have seed, sitting in the garage in a bag, it's not going to do any good. You got to plant it. So just having cash sit around, cash is trash. Being in a good investment. One reason to stockpile cash is if you have, if you see the market, if it's hard to predict, kind of anticipate there's stock market has gone whoop, 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 and rough times are down, down the road. Maybe piling up cash for that reason might be okay, because as it crashes, you invest. But who can time it perfectly? That's hard to do. But the key thing is best to keep it planted. And I really like the S&P 500 index funds. I mean, if you do the studies, people who individually invest in stock compared to the people who just plop it in the S&P 500 index fund, S&P 500 index fund beats it almost every time, like 90+% of the time. And the standard.
And what's your favorite S&P 500 fund?
Yeah, the Standard & Poor's 500 index, for those who may not know, can be thought of as the 500 biggest companies in the U.S. And there's certain parameters in order to qualify. Even if it's a big company, it has to qualify to be considered in that index. So, and that way, if one of them goes to pot, well, it doesn't matter. You got 499 other companies to support the portfolio. But people who pick individual stocks, unless you're a professional at it full time, the track record is not good. Even Warren Buffett recommends people invest in the S&P 500.
So say someone is using a brokerage, they have an app, or they say they have Robinhood, they have Charles Schwab, and they're going on there and they don't know which fund to pick. They're looking for the S&P 500. What would you say? Which ones would you recommend someone look up? Like what ticker symbols, what funds or mutual fund, what ETF would you say would be the most accurate?
I like Vanguard. Yeah, I like Vanguard S&P 500 index funds. I mean,
it's like the VOO.
Yeah, VOO is good. Yep, I like that one. VTI is another one, but VOO is a good one. Yep, I like that one.
There's also VOOG, the focus on growth.
Yeah, growth. That one's sometimes done better and sometimes done worse than the VOO. VOO is a good one.
Right. So the VOO seems like the best of both worlds, where the growth seems like more risk, maybe higher reward, and then the VOO, there's a VOOB.
Yeah. So the key thing is with the S&P 500 index funds. With the other ETFs and mutual funds, you're paying a money manager. They get a fee. There's an expense ratio is going to be higher because you actually have to pay somebody to manage it. With the S&P 500 index funds, it's just buying the index. So there's not a whole lot of decision making, paying these experts to go out there and fly out and research the companies and look at their financials. It's just investing in the index, which beats most mutual funds anyway. I think it beats something like 70 to 80% of mutual funds. It's a standard S&P 500.
So you would recommend inactively. So you wouldn't recommend actively managed mutual funds. You'd recommend more of like one that tracks an index.
Here's the key thing. So it's not how it did last year, because last year, in a 1 year period, in a short period of time, usually very focused index goes up because one sector of the economy does better than the other. But long term, that's not a good strategy. Like, for example, sometimes medical goes way up. Sometimes, the gas and oil industry goes way up in a short period of time. So you got to look at how has this mutual fund performed in the last 10 to 20 years? And if it's a managed fund, did the money manager of that fund change over that period of time? Because you might have a smoking hot money manager that managed that fund for 10 years, but now you have somebody who's wet behind the ears managing it now, and the results could change. You have to look at the long term. Also, look to see if that fund, mutual fund or ETF, had a great big huge jump in 1 year, like a lucky jump that could affect the overall return.
I see.
And so what I like to do is I like to put it on Google or Yahoo Finance. They're free. And you just compare. So you take a stock and push down below more information. And on that screen, you can add other stocks. So you can have the S&P 500 index fund as a line for the last 20 years, compare to see how that index fund or the mutual fund did over the past 20 years. So the key thing is you compare your investments to how the S&P 500 index does.
I see. Yeah, and I think with Yahoo, you can actually go in the summary, and it has just has it right there, the 10-year return. So if someone didn't want to go through the whole analysis of spreadsheets and all that.
Yeah. So look at the long-term return, and that's the thing to look at.
Or is 10 years long enough for time horizon?
10 to 20. But you also have to look for lucky jumps. Was there some kind of a lucky jump in there somewhere?
Yes. Yeah. Because I look at stocks like the QQQ, which has had a really good 5-year return. But
I really like that one.
Yeah, the fund started right at the beginning of the .com bubble, and so I noticed that it seems like it has a lower 10-year return when it actually doesn't, because it was kind of started during a bubble. That's another thing to look into as well.
Yeah.
It's interesting. So so no individual, and I think for a lot of people this doesn't sound very sexy. I guess they want to maybe start their own business or something like that, but a lot of times I kind of see the stock picking and not going with the ETFs or not going with funds as almost like trying to. It's almost like if you keep touching your fund, you're more likely to mess it up. You're messing with your savings.
Exactly.
Because you're going to lose money, and then you're going to try to be like, oh, I can get it back, and then you might gain a little bit, and then like, oh my gosh, I'm so good at stock picking, and then you go invest in another stock, and it goes down, and it's almost like trying to pluck your eyebrows or something, and like trying to keep them even, and then all of a sudden you don't have any eyebrows after a while.
Exactly, that's right.
Like, oh wait, no, this side.
Plus, you got to take the tax consequences into consideration of this buying selling thing, right?
Right.
Now, one good thing I like about ETFs. Okay, here's the thing with an ETF. Okay, with a mutual fund, when the money manager buys and sells stock and makes a profit and so on, the tax burden is passed on to you personally. But with an ETF exchange traded fund, that's like buying a stock that happens to own other stock. The ETF is responsible for the taxes, and it doesn't pass through to you. So you don't have to pay the taxes if there's trading going on within the fund.
I see. Okay, got it. So
not directly.
No taxes paid.
When you buy it and then you make a profit and sell it, of course, there's taxes there. On the churning that happens within the fund itself, if it's a mutual fund, you're responsible for the taxes. With an ETF, you're not responsible for the taxes with what happens with the churn within the ETF. I like the ETFs. And naturally, it's going to affect the value. Money comes out of the value of the pot that you own part of. It kind of like not stroking the check at the end of the year.
I see. Yeah. So, and on that subject of taxes, a lot of people have 401ks, and they have two primary options, which would be the Roth 401k and the traditional 401k. It seems like a lot of people choose the traditional 401k. Which one would you recommend, and why?
Definitely the Roth 401k, because
really?
What are you putting money in there for? You're putting money in there to take out at retirement. So when you're retired, you want to be taxed when you take it out, or no tax when you take it out, right? You're making more money now usually than you would in retirement. So
right.
Definitely the Roth, 100% in my opinion. Some people say, well,
so you're saying to buy the one that...
Yeah, so with the traditional 401k and traditional IRA, when you put your money in there, you get a tax deduction for it now, right? But keep in mind, if you have, so you max out the Roth 401k, however, it may not be tax deductible to put it in. But if you put $100 in there now, and it's $500,000 when you retire, or $400,000 or $300,000, whatever the number is, then when you retire, you don't have to pay any tax on it. You want to pay a little bit of tax now, or pay a huge tax when your income's less and you're older. The whole purpose of a retirement plan is to help you when you're older, right? Well, it's certainly not the time you want to pay a big pile of taxes.
Yeah, it seems like a lot of people don't know that.
There's only one person that's going to take care of that old man that you'll be someday, and that's the young man you are right now. There's only one person that's going to do that. There's nobody else that's going to do it, right? They're not just going to magically fall out of the sky and pour gold on your head when you're 65, 70, 80, and you're going to feel about like you do right now, as far as liking to have a good time, like to go out to dinner, like to go on vacations and travel and have fun. You're going to still want to do fun things then, but there's only one person that's going to take care of that old person, that you're going to love that young person you are now if you take care of that person now.
I see.
When I was younger, I always thought about my future self, and that's why I invested and saved and stocked it away. I was thinking about taking care of that old man that'll be someday, and here I am. Hopefully I'm not that old, but I'm older than a lot of people watching the show.
Yeah, a lot of times it seems like people are living for the moment, and I think that and that's, you got to look out for your future self as well while you're doing that. And that's why, like, I mean, everybody that I work with. So I'm an engineer, for those of you who don't know, and at a big defense contractor. And I mean, I don't even know anyone that does the Roth 401k option, and they think like, oh well, I'm saving a little bit of taxes now, and it's like really marginal because you're not going to see that money anyway because it's going into the 401k every month. So you might pay like a little bit extra on, you might have like a little bit less in your paycheck because now your entire income is taxed.
Right.
But it's, it's nothing compared to paying taxes on possibly millions in capital gains when you're 60 years old or something, say if you end up staying at that job for that long. And in addition to that, a lot of people don't know that the tax brackets are, you pay your tax bracket once it gets over a certain amount. So let's say you have, for example, like a 20% tax bracket when you're up to $60,000. And then after that, you have a 30% tax bracket. I mean, those aren't actual numbers, but just, make that up. I think significantly less than that. But if it's, so you're not paying that, say, 20% on 6,000, or let's say you're making 100,000, you're making, you have to pay like 25% tax. You're not paying 25% tax on that entire 100,000. You're paying 20% tax up to 60,000. And then that additional 40,000, now you're paying 25% on that. So if your income is a little bit higher and it pushes you into a higher tax bracket, you're really paying just a very minimal amount compared to what you would be paying however much on hundreds of thousands or millions of dollars in capital gains in the future.
True. I was just calculating something. So in California, there's this tax, it's at 12.3% is the highest. And then if you have $1 million or more, it's a percent more. So that's 13.3%. It's the highest taxes in the country where you live. I know now you're in Nashville, you live in California for the audience. So if somebody has a couple $1 million a year income, that is $996,000 in taxes in California on a $2 million income. $996,000 in taxes on a $2 million income. That's like almost half, $4,000 less than half.
It's ridiculous.
So that's one of the reasons why I moved to Florida. I got to keep a lot more of it.
Yeah, and now anytime I talk to my dad on the phone, he's always trying to convince me to move to Florida. That's one of the main things is that state income tax, and that is definitely a big thing. I look at my paycheck every 2 weeks, and I'm like, pay that much to California? Yeah. And
well, you got to live where you want. And California is a beautiful state. Florida's a beautiful state too, and it has no state income tax. So there.
Yep.
Texas is great too. It doesn't have any income tax. Good state.
I think there's 5 states that don't have any income tax.
Oh,
Florida, Texas, Nashville, I think. I mean, not Nashville, sorry, Tennessee. I'm in Nashville. Anyway, so yeah, I think that's about it. I don't have any more questions for you, but I think this was a really good discussion. And
very good. What's your opinion on the debt thing?
So, okay, my opinion on that thing is, I think there is a certain amount of interest rate where it wouldn't be very smart to pay it off immediately. So I guess for me, and this is really just an arbitrary number I'm picking, but it would be something that's, if you have debt and it's half of what the average S&P 500 return is, say it's 5%. So I try to not take out any debt that is over 5%, and I would only do that on a thing that would benefits me. So, and it isn't going to go down in value like a home, or if I needed to take out.
I have no problem with somebody taking out a mortgage on a home. No problem that they live in.
Right. Yeah. So, but I would even consider taking a loan out on a car if it was very low interest rate. If I were, because I feel like it's right now, since it's very, very high, the interest rate's very, very high, I probably wouldn't. But if it's something that's under 5%, I think it would make more sense because, over a 5-year time horizon, it's very unlikely that the S&P 500 is going to be, returning something less than 5%.
And that's one case where I disagree. Now, I was foolish because I didn't have the knowledge. I didn't grow up in a wealthy household. I grew up, middle class father who worked for the government, federal government, and so I was foolish. I always had to have a new car, and I leased them. It's the worst possible way to buy a car. Most expensive if you do the math. And so my belief is, if you can afford the monthly payment, right? You're going to be making the monthly payment anyway. If somebody borrows that money. You can also afford to put that same monthly payment in a savings account each month and pay cash for the car, my opinion, right? So when you're putting the payment aside each month, if you want to invest it, go ahead and have it go up the 10% a year or 11% per year annually, S&P 500 index. Usually you wouldn't do that for a short term. Yeah, so you're making the money, then go ahead. But if you can afford the payment, you can afford to put that monthly payment in a separate account each month and then pay cash for the car. Now, you typically get a better deal for the car than you would if you financed it. And what I really recommend mostly is buying a car that's 2 years old or older and paying cash. Now, if somebody has $1 million or more in net worth, go ahead and buy what you want. I can buy whatever the flip I want now. So that's my recommendation. You knew the feeling of relief of not having payments, not having debt. I do have the mortgage on the house, but not having these payments on a car and a boat and another car. Mom and I each have cars. The feeling to not have that payment, how good that feels.
Yeah, definitely.
And you can get a better deal on the car too by paying cash than you can financing it. Typically.
I mean, I think there's certain ways to use debt, and I think that there's an emotional aspect of it as well. Like you feel a lot better if you don't have these huge payments. But I mean, I really think if a person were to get debt to buy a rental property and it's cash flowing, and say it's cash flowing $500 a month, and they were to use that cash flow to go and finance a car.
If everything goes right and the person makes their payment, then they get the $500 a month.
Right, and then that's where I think the just being smart about it and finding a good tenant, really vetting them, not just being extremely risky and just relying on the income from one property. Yeah, I mean, like my personal view is I think that can help out a lot of people that might not have a huge savings, and I would say probably utilize that debt, like very low interest debt, to build up some passive income. I guess no income is really passive, but to build up the rental income, or maybe even
you just made a good point there. People call real estate investing passive income. Nothing passive about it. If anybody's owned rental property, there's nothing passive about it. It's very active. So you made a good point there.
Right.
Yeah.
Yeah. With that, it's even if you have a property manager, you're still managing the property manager.
So somebody says, do you know what I can afford it means to most people? It means I can make the monthly payment if I keep my job. That's what I can afford it means to most people. Here's what keeps people middle class. What keeps people middle class is car payments, whole life insurance, and credit card debt. That keeps people middle class. Those three things are the main things. There's other things too, but those are the three main things.
I see.
So if you follow my philosophy, if you can afford the monthly payment for a car, put that amount in a savings account every month until you can pay cash for the car. You won't have the payment. It's the same money every month. You can pay cash for the car.
That's true.
Yeah. So no, you're not going to get wealthy paying money to banks with furniture nicer than yours, with buildings taller than any building you own, right?
Right.
Why do they have those great big buildings and all that nice furniture? Because middle class people are making them rich. That's why.
Makes sense. Yeah.
Making those payments. That's what keeps people middle class. Is those monthly payments they're paying to banks.
What do you suggest that people do with their credit cards? Do you suggest that they take them out of their wallet? And what do you suggest they do?
The best
next time they take a look at them.
The best use of credit cards is right here.
There we go.
Right? I have.
Even better if you have a shredder, right?
I just talked to a family member who said, "Yeah, but I have the credit card, but I don't use it." And I said, "You should cut it up." Yeah, but I don't use it. And that's like that's like a drug addict saying, "I've got my stash in the bottom drawer, but I don't use it." Right? Credit cards are the bane of middle class and poor. You don't, they belong in the garbage can, all cut up into pieces. Use debit cards, not credit cards. And I don't care what some 19-year-old on TikTok says.
Yeah, well, I mean, I think because you do keep on saying the 19-year-old on TikTok, but I mean, there's people like who we were just talking about, who like people like Robert Kiyosaki, who like really offer completely different advice, who are very well respected.
He does offer different advice, and I'm sure he's a good guy. I think he's likable, but I differ on his thinking that there's this good debt. It's a negative on your balance sheet. It's good if everything goes well, but everything doesn't go well. This is the real world.
Right. And yeah, in my view too, I think there are people that might care less about having debt, and that they might have more of a less of an emotional reaction to debt. And then when a person goes and listens to Robert Kiyosaki and starts like building up all this debt and based off of the advice that he offers. And then they end up in a position where, oh my gosh, I'm really stressed out that I have this huge payment, even if it's cash flowing. And yeah, because I see a lot of my friends in that position where like they may have a lot of debt, they might have thought it was a really good idea, and they're always stressed out about making these payments.
Exactly.
And it's like it really can affect your quality of life, even if it's logically a financially smart decision.
You know, it's funny. Mom and I talk every morning. So every morning I get up at 5 a.m. I go get coffee and I bring it in to her and me. And I sit in the chair in the corner of our bedroom, and she lays there in bed, you know, kind of propped up on pillows. And when we talk every morning. And so I came in this morning. I said, you know, the last week or so, I've been having a hard time staying asleep, but it's not for reasons that you think. It's not that I'm really having a hard time physically going to sleep. It's that I'm so happy in my life right now that I just can't wait to see what's going to happen in the morning. So I was looking at the clock, hoping that it would hurry up and get to the time and that I had enough sleep, because I was wanting to get up and experience life. Because of that, following these principles, I'm living the life of my dreams. I'm happier than I've ever been in my entire life. I'm just so excited to get up in the morning to see what's going to happen. And it's
almost like a kid about to go to Disneyland the next morning.
It is. Every single morning I got to live like that, because I don't have all these crushing payments I have to make, you know? So that's what it feels like.
And then you immediately got up from bed, went to the store, and bought a keep calm and carry on sign.
Yeah, exactly. Yeah. There you go. Yeah, right back there. The old British World War II, when they're getting bombed, the Queen had those signs put all over the city of London. Keep calm and carry on. Even though bombs are dropping, just keep calm and carry on.
I didn't know it had that history. I thought it was like
that's the history.
A lot of people had those shirts. Keep
That's
calm and carry on shirts all over when I was in high school.
Yeah, those are the signs the Queen had placed all over London and probably all parts of the rest of the UK. I know we're being bombed. I know this is a bad time, but just keep calm and carry on. Live your life. I tell you what, I'm living the life I love. All my dreams came true. I wrote down a bunch of goals when I was, I think I was 20 years old. I wrote down 100 things I want to do in my lifetime. And I'm living that dream that I set when I was 20 years old. I wrote 100 things I want to do in my lifetime when I was 20. And I've accomplished almost all of them. And I'm just so tickled pink about my life.
That's great. Except, okay, there was what I did. I think I read through that list. I think there was one on there that said you wanted to go to the moon. So you still got to do that.
I guess I still do. But, you know, some of the things I wrote back then I don't want to do anymore. Like going to the moon is not a priority in my life. Back then I thought it'd be cool. But, I was coming up with 100 things. there's the important things, like I want to be a millionaire, get married, a beautiful woman, those kind of things. Accomplish those things. But there's but then if you get to 100, you kind of have to stretch a little bit. Going to the moon is one of them. I mean, I wouldn't mind going to the moon. I probably wouldn't turn down the trip if somebody wanted to offer it to me. But it's not a priority in my life right now.
Yeah, maybe one day you can get on one of those Virgin Galactic planes and at least get to orbit.
Hey, Richard. Get close enough. Richard Branson. Yeah, let me ring him up. As soon as we hang up, I'll ring him up and say, hey.
Yeah, there we go.
So I think we're good.
Yeah, great. Yeah, it was a great conversation.
All right. This is the business guy and the business dude, and we're signing off, and I hope you got some value out of this video. We appreciate you watching. This is the business guy.